Hi, I'm Russ Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Chris Verrone. Chris is a partner at Strategas and the firm's chief market strategist. Chris, how are you doing today?
Ross, I'm doing great. Great to be here.
Yeah, great to talk to you. Timely as well because we're recording a day after we got a hotter than expected CPI inflation print. Obviously, the market very hypersensitive to inflation at this moment in time, but I wondered if you could talk through the reaction from the various corners of the market, what maybe was expected, and then maybe what was unexpected, and what that tells you about the state of things.
Yeah, certainly a hotter than maybe anticipated CPI print yesterday, Wednesday. But just go back and look at the last 3 or 4 weeks. This has been a very resilient market in light of some pretty important revelations. The first of which was maybe 3 Mondays ago, the revelation of the Chinese AI program DeepSeek. Market actually traded pretty well in light of that. Last Monday, the tariff talk, again, the market kind of held in there, and then yesterday with the hot CPI. So this has been a pretty resilient tape in light of what's been thrown at it. And just looking at this week's price action post CPI in particular, rates did pop, and they're kind of back in that uncomfortable zone of 455, 460. But dollar is basically on the year-to-date lows. That did not rally yesterday. Credit conditions remain very benign. Discretionary was better than staples yesterday. Europe traded great. Copper was at the highs. Oil went to the lows. So I think broadly, the macro messaging is really not all that sinister, despite some of these pretty important revelations over the last several weeks. And it's just another example. We always say in our work, we'll defer to the market's opinion over our own. It's so easy to look at these headlines and want to get super negative. The market's really not allowing for that here.
That is a really great point. And I do get the sense in talking to some of our clients that there is a growing skepticism that this bull market can continue to kind of hold serve through 2025 and into the back half of the decade. You talked about the resilient tape, but what are some of the things that you watch closely to get a sense of whether this bull market is continuing or whether something more sinister, to use your words, is starting to appear in the market?
Yeah, so let's be clear. This market is certainly more split under the surface than we've probably seen in 18 months. That's not fatal or catastrophic. That's just reality. And the goal of our work is always to deal in reality, not in conjecture. So certainly more split. I think at the start of any year, particularly in a split tape, you want to get in gear with the leadership as quickly as possible. I think on the good side, certainly welcome that financials generally remain market leadership here. I think that's important. Comp services continue to trade well. Then you get to sectors like industrials and tech and discretionary, which are probably more split than we've seen at any given point. Take discretionary, for example. The home builders and the building product stocks have generally been on the softer side along with the autos. But on the other hand, stuff like travel and services continues to act great. And then you kind of look globally, maybe there's some little hits to cyclicality at home, but globally, cyclicality is alive and well. I mean, the cyclicals are pretty dominant right now in Europe. We've seen China, I think, with a pretty important turn here. So we're in this maybe a bit of a transition phase. As you note, it's year three off a low. It tends to be more of a volatile year, more of a split year. But I think the good news is, particularly when you look outside of the U.S., there are other geographies that are really picking up the baton here.
Yeah, and I think that's an important point to note because after 15 years ish of U.S. outperforming international, I think a lot of folks are ready to throw in the towel. But as you note, some nascent strength there from different corners of the global market. I want to maybe get you to expand on that a bit and then talk about how the dollar plays into that, because we've been in such a strong dollar environment. And as you noted, in response to that CPI print, the dollar didn't necessarily rally as you might expect. What's the interplay there, and how does that inform your like for international at this point in time?
Well, yeah, let's start on the dollar side of this. And one of the rules in our work is always when things don't respond as you might think that it should, then the joke's on you. So when you look at the dollar here just the last couple of weeks, first with the tariff revelation last Monday, and then with hot CPI yesterday, I mean, dollar reversed very sharply off the highs last Monday and then really continued lower yesterday. So I think certainly the dollar reflects an environment where long dollar or bullish dollar positioning is probably pretty full at this point. So I lean more towards certainly neutral, if not weaker, USD here. And this is at a time where you've already seen, the big resets in peso and euro and sterling and CAD. So, one of the rules kind of in macro investing is when the currency resets, the next thing you do is you look to the equities to kind of be the benefactor of that. So the response from these European equities in particular, not just the last couple of weeks, but frankly since the election, have been pretty remarkable, particularly with like really good leadership. You're seeing European banks, European industrials, European discretionaries really drive that here. And it just kind of reminds us, and Dan Clifton and I have been talking about this idea that, maybe the irony of the Trump win back in November, amid all this talk of American exceptionalism, is it actually forces change in other parts of the world. And that's what the market really is beginning to pick up. And you see it not just in Europe. Frankly, you see it in China. I know it's a polarizing part of the world, but there are some legitimate turns in a lot of these Chinese indices. And, I recognize Chinese equities, certainly not for the faint of heart out there. But if China has turned here, particularly from an economic perspective, the tentacles of that are far more reaching than just what Chinese stocks are doing. There's certainly an impact on Europe, probably certainly an impact on cyclicality and metals globally.
Yeah, that's a very counterintuitive development and something that I'm glad you have your eye on, because I do think, as I mentioned, investors have started to throw in the towel on international. So good to know, Chris. I really appreciate the time today. We'll look forward to catching up again soon, and talk again soon.
See you soon, Ross. Thank you.